Good evening, ladies and gentlemen. A very warm welcome to each and every one of you, and thank you for joining us today for another engaging edition of IACC Thursday Insights. I am Parvaz Shah from the Indo-American Chamber of Commerce, West India Council, and it is my pleasure to welcome you to today's webinar on falling INR opportunities for the exporters. Before we begin, I would like to extend a warm welcome to our IACC WIC leadership, who are the ones behind driving this initiative. First, our president, Mr. Raghavendra Pongshe, a second generation entrepreneur and a distinguished intellectual property advisor. Though he couldn't be present with us today, he has sent his best wishes for the session. Next, we have our Vice President, Mr. Tejinder Pal Singh Oberoi, Executive Director at Signet Infotech. He holds a background in IT entrepreneurship with extensive experience in leading technology firms. Along with him, we have our Vice President, Mr. Manoj Balwani, a certified AI journalist and an alumni of IIM Ahmedabad, for a full-time entrepreneur and a seasoned management consultant who will also be moderating our today's session. We are equally delighted to have Mr. Prateek Vaidya from the National Executive Council of IACC. He is a distinguished business leader and a global entrepreneur, currently serving as a chairman and managing director across multiple ventures spanning from the US to UK, Canada, and Asia Pacific. We are honored to have with us our esteemed speakers, Mr. Saurabh Mukherjea, founder and chief investment officer at Mercilis Investment Managers. Saurabh was instrumental in setting up Association of Portfolio Managers in India as its founding director, which is an industry body for the Indian portfolio managers. He continues to be a part of multiple SEBI working groups whose role is to review and reform the rule governing portfolio managing in India. Saurabh is also the author of the many best selling books. Mr. Anupam Gupta, who is our host for today, and he's an author and a podcast host. Prior to which, he was a research analyst in some of India's largest equity bookages. Anupam hosts Paisa Vaisa, one of the India's longest running podcasts, and his last book was The Rise of Asian Paints. Before we begin, we encourage you to post your questions in the Q&A or the chat box. Throughout the session, we will take up these questions at the end of the session if time permits. And if not, we'll be sending the answers to you via mail. With that, it's now my privilege to invite our Regional Vice President, Mr. Tejinder Pal Singh Oberoi, to deliver the welcome address and formally inaugurate today's session. Sir, you are on mute.
Thanks, Parva, and good evening, everyone. It gives me immense pleasure to welcome you all to another insightful session of IACC Thursday Insights. Insights, Ideas, Impact, Knowledge Sharing Initiative of Indo-American Chamber of Commerce. On behalf of IACC West India Council, I extend a warm welcome to our distinguished speakers, Mr. Saurabh Mukherjea, along with our host for this session, Mr. Anupam Gupta, and our esteemed moderator, Mr. Manoj Balwani. Today's discussion, Falling INR Opportunities for Exporters, is extremely relevant in the current global economic environment. Current currency movements have a direct impact on businesses, particularly exporters, influencing competitiveness, pricing strategies, margins, and opportunities in international markets. While a depreciating currency presents certain challenges for a broader economy, it can also create significant opportunities for Indian exporters who are prepared to adapt, innovate, and strengthen the global presence. Understanding these dynamics and developing effective strategies will be crucial for businesses looking to expand their footprint in international market. Through IACC Thursday Insights, we continue our endeavor to bring together industry leaders, experts, and professionals to discuss emerging trends, share knowledge, and provide meaningful perspectives that can help businesses navigate an evolving economic landscape. With that, I welcome you all once again and look forward to an engaging and insightful discussions. Over to you, Manojji.
Thank you, Tejinder ji, and a very, very good evening and a good morning to people who are overseas, maybe in the US as well, right? So a very, very good morning and a good evening to all of you, and a very warm welcome to this IACC Thursday Insights session. As Vice President of the Council, it is my absolute pleasure to be moderating today's discourse. And as Tejinderji said, the Indo-American Chamber is a premier bilateral chamber, 57 years old, and we've been doing a whole lot of activities as a chamber to advance Indo-US trade, investment, and economic collaboration. We do have over 1,800 active members and a broader network of over 12,000 corporates who are part of our network. Today, as we dive into this topic about falling INR, opportunities for exporters, the headline logic seems very simple, right? A depreciating currency should have an immediate windfall for exporters. But as anyone operating on the front lines knows, the real picture is far more complex. From imported raw material to global USD freight charges to mandatory treasury hedging policies, and maybe buyers sometimes demanding price cuts, right? All these are the challenges that can have an impact on net margin and take a lot of strategic mastery to kind of navigate, right? So without much ado, we have two very eminent panelists here with us today, Saurabh Mukherjea and Anupam Gupta. So without much ado, Anupam, I'd like to hand over the floor to you to host the conversation, and I'll maybe jump in with a few questions along the way. So over to you, Anupam.
Thanks a lot, Manoj, and thanks IACC, thanks TPSG and PAR for that wonderful introduction. Saurav's latest book is actually called Breakpoint: The Crisis of the Middle Class and the Future of Work. So let's start the session. Saurabh, let's set some background to this, right? I read a recent note that you had sent, I think from your blog. You said that the rupee's decline since 1991 from rupees 18 to rupees 96 per dollar has been the calmest depreciation in the emerging world. Let's set some context. Explain this to our audience, please.
Yeah, sure. Thank you, IACC. Thank you, Tejinderpal Singh Oberoi. Thank you, Manoj Balwani, for hosting us. Privilege being here. So just let's get straight to the point Anupam made. Right, 5% a year. That's been the depreciation of the rupee since 91, and barring specific crises. Right, I'm sure we all remember the 91 crisis. We'll also remember the 2013 crisis and the mini crisis of the last 12 months. But barring these 3 or 4 episodic crises, over 35 years, 5% a year without major economic blow-ups, Anupam, is fairly rare, right? And the reason I think this has worked out for us is our IT services sector has been the mainstay of defending the rupee, right? So we're an unusual country. I'm sure everybody on this call knows we're the only country in the world which has gone straight from agriculture to services. The manufacturing stage, we broadly skipped over. We went straight from being an agricultural economy to services, where 60%, 65% of our GDP is services. And out of India's around $450 billion of exports, 250 some years, $300 billion is IT services exports. So what the IT services piece did, was as our IT sector grew through the 90s and noughties, it buffered the fact that we were actually struggling to be competitive as a manufacturing economy, right? Our high cost of capital, our weak infrastructure, unionized labor, all of those things meant that in manufacturing we really weren't competitive. And in spite of the fact that I'm pretty sure everybody on this call has an imported phone or laptop, we're doing this call on imported software. I'm using imported electronic equipment to do the call. After this, when I go home, my car is imported. I'm wearing an imported watch. In spite of the fact that we buy so much by way of imports, our IT services sector meant that the currency gradually gave up 5% of its value rather than getting plastered by 10-15% a year, right? So the calmest depreciation is the simple way to state that over the course of 35 years, this is an economy which has gone from 18 to the dollar to 96, and yet it's done so without a major economic blow up, barring 91 itself, and then the 2013 crisis when Raghuram Rajan took over as RBI governor and bailed us out. It's unusual. It's very strange, very unusual to see an emerging economy pull this off. And hats off to our IT services sector for having given us this 35-year period of calm. But implicit in that, Anupam, is that calm is over. A very different future lies ahead for India. Hence, the name of the book is Breakpoint. The old world, the 1991 world, is blowing up in front of us, and a very different future, promising future, I think, lies ahead of us.
Sort of also, you studied the economies of emerging markets. You know how dollar depreciation plays out there versus export competitiveness. So how does India's rupee trajectory impact our relative export competitiveness, right, against our competing corridors? Like Vietnam, Mexico, ASEAN. How does that play out?
Yeah. So again, let's set some historical context. So it was in the 1960s, Anupam, that the first big Asian exporting miracle, Japan, took off, right? So World War II ends, Japan is utterly decimated, America gives it some aid. 50s, the Japanese rebuild, 60s, they gain steam, and 70s, in the oil crisis, when oil prices, I think in one decade, oil prices went up some 7 or 8x. Japan comes its own as a manufacturing superpower. Deng Xiaoping studies Japan very carefully, and early 80s China reforms, through the 80s Korea, then Taiwan, then China take off, and you have the East Asian tiger story. So even say 10 years ago, it was well established that for an Asian economy to take off, you needed not just an efficient manufacturing sector, Anupam, you needed a depreciated currency, right? So China, for example, in the 10 years prior to entering the WTO, China entered the WTO in 2002. In the 10 years prior to entering the WTO, China broke its currency by 50%. Right? They deliberately hammered the value of the RMB, devalued it to make it super competitive. And the benefit was, when they entered the WTO in 2002, over the next 15 years, their export growth in dollars was 17 or 18% CAGR. Right?
Wow.
So for 16, 17 years, Chinese exports both to Europe and America CAGR compounded at 18% per dollar. But that was because they gained so much competitiveness through the 90s by devaluing the currency, plus by having low cost of capital, low cost of land, rules and regs which manufacturers could put up with rather than being bankrupted by. Right? And Vietnam in the last 5-6 years has followed the Chinese template, which in turn you could call it the Japanese template, because the Japanese in the 50s, 60s, 70s set this template: hammer the currency, depreciate the currency, support your manufacturing exports, and the combination of a devalued currency plus reforms on land, labor, capital will give you a world-class competitive export-oriented sector. Now, we couldn't do this partly because our IT services sector ensured an overvalued currency. Right? We had the benefit of having great graduates, the IIT, IIM graduate system, and numerous other very good regional engineering colleges. But the brilliance of these young men and women went that between IT services and pharmaceuticals, India was pulling in $300 billion a year of export income. That resulted in the currency being overvalued by 10%. 10% overvaluation in the currency means you're done and dusted. It's really difficult to build export-oriented manufacturing sector with 10% overvaluation in the currency. Right? That's been our historical fate. As a result of this, this year I turned 50, Anupam. Since I was born, every prime minister said, we will encourage manufacturing, we will build a world-class competitive manufacturing sector which will export to the Western world. It hasn't happened because everybody else is running a two-legged race. We're running a one-legged race with a overvalued currency. Just to put some numbers around this, take something as basic as textile exports. Our textile exports are $15 billion US. Bangladesh is closer to $50 billion US. Right? I know Bangladesh's tariff advantages will come to that. But Vietnam, Bangladesh, China, key rivals of ours in the export arena, have competed with devalued currencies. We have competed with an overvalued currency. But as we are seeing over the last year, as AI starts hammering our IT services sector, I think the good news for the folks on this video call is that I think the days of an overvalued rupee are going to fade pretty quickly, right? I think already the 12% depreciation has taken away some of the sting of the rupee overvaluation. But my reading is this is just the beginning. If I see the balance of payment situation, if I see the rate at which Indian promoters themselves are pushing money out of the country, right? We've never seen foreign FDI. Indian promoters are doing FDI outside India, right? Large promoters are cutting checks of 10 billion, 12 billion. Mid-sized promoters are cutting checks of 500 million, billion odd. As Indian promoters push money out of the country, as the IT services exports diminish, I think the rupee will crack through 100, head towards 110, and soon we will have currency as an advantage rather than a headwind. Allied to that is the other FTAs that the government is negotiating, right? I think the Europe FTA, we've done plenty of work on that, Anupam. Our reckoning is the EU FTA is a well negotiated FTA which gives several sectors in our country, such as textiles, such as auto ancillaries, such as precision engineering, such as organic chemicals. Several sectors will end up being cheaper than China, cheaper than our Southeast Asian competitors. So combine a devalued currency from overvalued to a devalued currency, combine the FTAs with UK and EU, hopefully soon with USA. I think for the first time since 1991, we have a fighting chance to build a competitive world-class export-oriented manufacturing sector, which can go head to head, not just with Vietnam and Bangladesh. Hopefully in a decade's time, it can go head to head with China as well.
Okay, so you've given me a lead into to my next question, and actually that I'll take a pause after I ask this question. I'll hand it over to Manoj. So, do the export-oriented manufacturers, are they the real prime beneficiaries of this falling currency? I'm asking because exporters usually also have dollar costs, right? Raw materials, freight, debt. So, who really benefits from the fall in the INR?
Sure. So look, if the net export, so the number we look for when we try to invest in an exporter, as stock market investors, when I assess a manufacturing company with an export-oriented clientele, we look for the net figure, right? Are you exporting more revenues than you're importing by way of cost? And assume that you're looking at an exporter with an operating margin of 15-20%, right? Those sorts of exporters who have 15-20% operating margins, and I appreciate that it is hard to get to 15-20% operating margin in export-oriented sectors, but high value-add exporters, 15-20% operating margins, or exporters whose cost base is largely domestic, but the revenue base is dollar-oriented. So an example of that would be textiles. Your cost base is domestic labor and cotton bought domestically or fiber bought domestically, and you're adding value to that in factories in say Tirupur, and then you're exporting that to say the Primarks or Walmarts of the world, and you're making up operating margin say around the 10-15% mark. You should be a net beneficiary thereof of exports. You should be a net beneficiary thereof dollar depreciation, rupee depreciation, dollar appreciation. Now, the situation you're highlighting, there tend to be some exporters, for example, jewelry exports. Right, we are basically bringing in the diamonds from outside. You're cutting and polishing them, for example, in Surat, and then you're sending them back out. Right there, I agree. The rupee falling is not an enormous win. Similarly, in refining crude, you're bringing in crude, refining it, sending it back out. So wherever it's quasi commodity type exports, and one way to understand this is gross margins below 50%. If it's a quasi commodity type export, Anupam, and gross margins are below 50% or low, there the rupee devaluing is not that much of an advantage. But if there is significant value add from an Indian perspective, either because we are applying Indian labor or Indian raw materials, and the dollar imports are modest, then the rupee devaluation plays out in their favor. If we look at the listed sector, we can see that the garment exporters, the auto ancillary exporters, the precision engineering exporters, the organic chemical exporters, they're having a superb time because the rupee is down 12%. I think with more to come. Their raw material costs have gone up somewhat, but not as much, and therefore we're seeing a degree of operating margin expansion already on the back of 4 quarters of rupee devaluation.
Okay, cool. So I'm going to hand it over to Manoj, Saurabh. He's going to be asking you some questions on the business side, right? Because
Yeah.
you've also you've met these exporters, you know their businesses, you know what separates the good ones from the bad ones. So I'll hand it over to Manoj now to to look at a few aspects and a few questions on the business side. I'll come back after a bit.
Yeah. Thank you, Anupam. So on the business side of things, the first thing that comes to my mind, Saurabh, is hedging, right? So as you would agree, most corporates already have hedging policies to cover their Forex exposure, right? So is this true only for large companies, and therefore do only mid and small companies who might not have treasury departments that hedge benefit or lose more? Or let's put it this way, do those uh, small and mid-sized companies, are they the only ones who get impacted by these currency fluctuations and the falling INR?
So Manoj, my understanding and my experience, and I'm a small exporter myself in the sense that we have foreign clients for whom we manage money. Right? My experience and my understanding is that we can all hedge. We can all hedge against rupee depreciation. It will cost us 3-4%. And we can go and hedge ourselves. Obviously, if we hedge ourselves, we pay that 3-4%. Our costs go up to that extent. And if I'm given that the structural story is of the rupee heading further and further down, if I'm a net exporter, right? If I'm a net exporter, it's not obvious to me why I want to bear that 3% cost of rupee depreciation, right? I will have, to the extent those on the call have certain imports that are in dollars. They might want to protect themselves against the dollar depreciation on the amount of their amount of their imports. And the better way to do that is hold. If you have revenues coming in dollars, keep those dollars as long as you can. The government has rules on that. The RBI rather has rules on that, I know. But if you have revenues coming in dollars, keep those dollars as long as you can so that you can pay for your imported costs rather than bringing the dollar back to rupees, then hedging it out, right? So this is where the RBI's stance on this subject becomes tricky. The RBI, as you know, is very keen that if you have dollar revenues, you bring it back to India fatafat as quickly as possible, right? But from where I sit, for most exporters who have some degree of imported costs, it makes sense to hold the dollars for as long as legally permissible, so that you can hedge yourself out like that rather than paying a 3%, right? But zooming out and taking the structural view, I find it difficult to believe that the current situation that we face, where we have a balance of payments problem, a foreign exchange problem, I don't think this will resolve itself without the rupee having a further sustained bout of depreciation and devaluation. If you're an exporter, you can benefit from that, and hence it's not clear to me why you will fully hedge out of the impending further depreciation of the rupee. By the way, the RBI will make efforts such as FCNRB to protect, to stymie the fall, but these are temporary efforts. The big sort of looming shadow on all of us is the colossal IT services sector and the structural challenge it faces as AI threatens to overwhelm the fact that the Fortune 500 companies simply don't need to buy $300 billion of IT services from Indian companies anymore. AI diminishes the sales potential of our IT services companies, which in turn comes back and creates a balance of payments problem, which in turn pushes the rupee down. And those on the call, if you're an export-oriented company with a big net exports number, you should be able to benefit from that. So if you can avoid the rupee hedge, from where I sit and from my understanding of the situation, it would make sense.
Got that. Thanks for that. So yeah, so from our, your this answer kind of helps us segue into my next question really, and which is more about the pricing power dynamics. So many of our members, when we meet them, they say that, hey, the foreign buyers are very much aware of what's going on with the Indian currency, right? So as soon as they get to know that the Indian rupee has kind of depreciated, right, then they ask us for hefty discounts. So how do our members in your experience, what advice would you give them? How should they tackle this kind of discount requests from their clients?
So I think, at many levels, from my understanding of the situation, and again, I'm a small exporter myself because I'm exporting investment advice and investment services to foreign institutional investors. My understanding of the situation is it's a negotiation, and what's critical here is your bargaining power. If your export is a specialized item and you've got some extra value add which your rivals don't have, I think you'll be able to stand your ground and hold on to the gains arising from the rupee devaluation, right? So that every rupee will fetch significantly more dollars a year hence than they do today. That every dollar of export revenue will fetch significantly more rupees a year hence than it will fetch today, and even more 3 years out. So your ability to hold on to the gains arising from the rupee devaluation depends on your bargaining power. Your bargaining power depends on how unique your product is, how much USP you have that your rivals don't have. The second way to think about it is, suppose you don't have such a unique product. You have a good product, competitive, but hey, it's not the first light bulb ever. This is not 1880, and you're not Edison, and it's not the first light bulb. I think there's always grounds for a discussion saying the Indian exporter will keep some of the gains, and say the American client will keep some of the gains, and you split the cake somewhere down the middle. And then the last piece is to say that, look, if you're saying that the gains from rupee devaluation have to be shared between us, then it presumably means that if the rupee were to appreciate, the dollar were to depreciate, those will also be the pain of that will also be split equally. So if your client in the Western world has a history of sharing gain and pain with you, then you're in a good place. If it's a one-way street where you're being dumped upon and you're asked to take the pain and the Americans get the gain, then I think you need to find a product and a USP which allows you to negotiate your way out of that. Most exporters I've invested in, companies that I've bought shares in, they are saying that they're sharing the gains with their American clients, because they're saying this is a long game. Remember, we're still a very small exporting economy. China is 10x bigger than us in almost every product you can care to imagine. And their point is, since we are just beginning the road with our American clients and we want to get a greater share of wallet in the years ahead, we're happily giving up some of the gains from the rupees devaluation to our American clients in the hope of getting more business in the years ahead.
That's such a wonderful suggestion, Saurabh. Having been in the negotiation, in the procurement activity for a long time, when I was part of an IT services company, one thing we used to say always when we were procuring mostly all the time, right? We used to say that we want to make this win-win for both parties. So it should never be tilted in such a way that it becomes a win-lose situation wherein one party is winning and the other is losing. And I think that's something that our members should definitely benefit from. This is a wonderful way to look at things, and wonderful way to kind of negotiate with your clients. So before I hand it back to Anupam, I think it's very clear that those companies that are more like services exports companies, which have low imported inputs, right? They can definitely enjoy a higher pure margin, from as compared to the physical manufacturing exports companies, right? Before I hand it over to Anupam, just one quick question. What mistakes do you think, Saurabh, exporters make during prolonged currency volatility?
So I think not just exporters, all of us, even myself as an investor, right? One of the things we are trying very hard in Marcellus to train ourselves for is this regime shift. The India that's existed from 91 to 2026 is by and large gone. Right? In the next 2 to 3 years, the whole construct of the economy will change. So, for example, the IT services sector, because it's no longer growing, in fact, it'll start shrinking soon. It's no longer creating jobs. The IT services sector was the biggest creator of jobs in our country, by far the biggest. And net recruitment by the IT services sector, as I'm sure you guys know, is zero now. right? If the biggest job creating sector in the country is conked off, it obviously has structural implications for our domestic economy. But extending that to exports, I think we are now headed for structural decline in the rupee of the sort we hadn't seen for many, many years, because the mainstay of our export economy is melting in front of us, right? Now the conservative strategy, and I am a middle class born, born and raised with fear in my veins that life may don't take any risk in life, right? The conservative strategy would be to say, well, the rupee will only give up 4-5% of its value. Hence, let's not get too carried away about our export prospects. But I think there is good reasons to believe, as I was saying, that for our balance of payments to balance, your sector, the sector that you guys represent, has to flourish, because otherwise the shortfall that's going to arise, the shortfall that will arise in our foreign exchange from IT services exports dropping will not be made up for. So it's not just that the currency will give way substantially. I think things like the cost of capital and cost of land also potentially comes off significantly. So if the politicians, and we had, for obvious reasons, I've ended up discussing this with our leaders and politicians. My view is that if you don't want to let the cost of land come off, jack the FSI up. If you don't increase the FSI, and our land costs in, say the part of the world I live in, Bombay, Pune, Nashik triangle, our land costs are 2x that of Vietnam, for example. If we are to compete in the global manufacturing ecosystem with Vietnam, with the current land costs, you have to double the FSI, right? Similarly, cost of working capital. Cost of working capital in our country for mid-sized exporters will be 10, 11, 12%. Corresponding figure in Vietnam will again be 3%. America is 3%. China is 3%. We're competing in a world where all our rivals have anywhere between 3 to 6% cost of working capital, and our companies are paying 10, 11, 12, 13%. That's not tenable. Cost of capital has to come down, for which the government of India will have to crash spending. What's happening is the government is pulling out from our bond market in Mumbai the best part of 30 trillion rupees of borrowing every year. That's jacking up the cost of money, which makes our working capital very expensive. So I think there's a big structural shift that we are headed off. The currency shifts structurally. Cost of land shifts structurally in the sense that it shifts down, i.e. FSI goes up, and potentially cost of capital comes down. If these things don't happen, Manoj, the currency will crack that much more to make our exports competitive. So that's, I think, the regime change we are facing. It's a once in a generation opportunity for all of us, but it requires nerve. It requires nerve on my part as an investor to grab it. And I'm buying as many export-oriented manufacturing stocks as I can. I'm also investing aggressively in Europe and America in companies over there, because I think the rupee deval will help. But it requires nerve to do so, because a gradualist approach will say, don't worry, 4-5% is all that the rupee will fall. It's the same old, same old. Don't think too much about manufacturing exports. Chote mein khush raho. So if you, like me, believe that this is a regime shift and now the next 10 years belongs to Indian manufacturing, then I think your business strategy will be very different to those who sort of write in our newspapers daily saying this is an incremental change. Nothing structurally has shifted in our country, really.
So before I hand it over to Anupam, just one follow-up question from what you just said, right? Help me understand, if I'm not mistaken, what I heard you say is that because we need to look at it not from an investor's perspective, maybe, which you just now did, but maybe from the entrepreneur's perspective, right? This guy is in the business of steel or textiles or whatever, right? Now, you just said that you need to also look at which sector you think is going to grow. So, if I understood that correctly, so if a guy is into textiles, is he expected to move into steel just because textiles is not going to do well for the next decade?
Right. So I think that's a strategy shift that I think a management consultant is better placed to answer than an investor. All I can say is, basis where we are sitting, our analysis of the situation and discuss with manufacturing exporters suggest, let's take the EU FTA. In the EU FTA, Manoj, we are seeing, say, five sectors where cumulatively India currently exports only 50 billion. But we can see that the actual export opportunity in the European context is closer to 5 trillion, right? So 5 sectors. What are those 5 sectors? Textiles, footwear, auto ancillaries, precision engineering, and pharma ancillaries, organic chemicals, or generally pharma ancillaries. These 5 sectors currently, India exports cumulatively between these 5. India exports 50 billion to the European Union, 50 billion euros, $50 billion, roughly the same thing. And we reckon we can see in the European economy that the export potential here is closer to $5 trillion, right? And in these sectors, our understanding of the FTA is the FTA puts us anywhere between 5 to 10% better off than China, Vietnam, or Bangladesh on the relative tariff position, courtesy the FTA that Piyush Goyal ji has negotiated for us. Okay, that's the scale of the opportunity. Now, those who are listening, can they jump into one of these? Should they jump into one of these? That's a corporate strategy call that will vary from person to person, from firm to firm. But from where I'm sitting, these are the 5 sectors where I can see our exporters can grow 2x, 3x by orders of magnitude in the next 5 years. Because in each of these sectors, China is 10x, some cases 20x bigger than us. But it's not just China, even Vietnam, even Bangladesh are 3x, 4x bigger than us. And I think the economic adjustments to make our exporters competitive will have to be made. Otherwise, the currency will get smashed even more.
Got that. Okay, over to you, Anupam. Thanks, Saurabh.
Okay, thanks, Manoj. So I just have a couple of questions more, then we can wind up and go to the Q&A. First is, how do smart promoters use temporary currency windfalls, right? What do they do that this audience could learn from? Should they reinvest that money? What should they do?
So this is a very clever question, and it's a tough question. And I'll tell you why it's tough. I'm not clever enough to answer the question. I can tell you why the question is tough. So obviously, as the currency keeps sliding 100, then 110, 120, right? As the currency keeps sliding, Indian exporters become more competitive, but their dollar wealth, the net worth of their business in dollars, potentially erodes, right? And hence, that same exporter whose business is becoming more competitive as the rupee slides, that exporter's ability to invest in the Western world actually gets eroded because the rupee is getting smashed, right? So one of the things that I'm seeing very clever companies do, and it takes a lot of gumption and a lot of strategic insight. And I'm not saying I can do this myself. I'm seeing other clever people do. They've figured out this tension that with each passing year, I'll get more and more competitive in Europe, for example, but my ability to invest in Europe will also diminish. So they're saying, I'll make the move now and buy a small European company, or buy a warehouse in northern Italy, or buy a warehouse in France or Germany. So whatever European asset which can give me a competitive advantage, either a local brand or a local sales and marketing team or a local warehouse where I can load up stuff, whatever European asset, I'm using Europe as an example, folks. This can also apply to America. Whatever European asset can give me a competitive advantage, I'll make the move now and lock and load on that right away, right? Because 5 years hence, the cost of that in INR will be far higher, right? Second piece I'm seeing is, broadly, people are saying anything which is labor intensive and involves a lot of assembly, lot of karigari, polishing, cutting, machining. I'll do that here. I'll ship the stuff in disassembled format to Europe or America. And then I'll do the final assembly over there, ideally to be on the right side of the tariff wall, whether it's the European tariff wall or the American tariff wall, right? So I'll try to get a European or American brand on my product. If I might have to buy that brand. I'll try to get a made in America or made in EU stamp on that product. I'll try to get a local sales and marketing team to liaise with local customers, a local warehouse, and I'll try to do all of that before the rupee ends up at 110, 120. So this is a very interesting tension, right? Your competitive position vis-a-vis our rival countries improves with each passing year, but your ability to invest in mature economies gets compromised. And therefore, there is a time when you need to move. And ideally, what I'm seeing, the smarter guys are saying, we'll move now.
Okay. From a investor's point of view, it could be an FII, it could be a private equity play, it could be a venture capitalist. How do those investors look at Forex-driven earnings growth versus, true operational growth, which is volume-driven more than Forex driven. How do they view that? Do they, ascribe different valuations? Do they look at it differently?
So it's a fascinating point you're making. As yet, Anupam, we haven't yet seen in this last 10-year period, we actually haven't seen that much investment by PE. This is not really a sector for VC. This is more a PE type sector. We haven't really seen heavy investments by PE in this space. We're seeing the beginnings of it. Chris Cap, for example, bought a stake in GMM Fodler a couple of years ago. We've seen a little bit, and where I think I think we will see more PE interest in this space. I think the PE interest will be triggered by the EU FTA. I think the EU FTA goes live in Jan next year, Jan 27. And as the EU FTA goes live and we see, say, 40, 50 listed exporters reporting bumper numbers, I suspect PE will come through, and PE will come through with a broadly similar framework to what I'm using. You're in sectors which are tariff advantaged: textiles, sports goods, precision engineering, auto ancillaries, pharma ancillaries. You're in a sector which is pharma tariff advantage. Secondly, you have decent operating margins. Thirdly, you have low imported costs and high value add from a domestic perspective. And I reckon there'll be hundreds of such companies in the manufacturing belts of the country. And over the next decade, much as what we have seen in internet over the last 10 years, the next 10 years, I think we'll see PE invest in the manufacturing sector. And my reading, and I'm hoping as an investor, that many of the investments I've made in companies whose market caps are, say, $100 million today, I'm reasonably confident those market caps will be north of $1 billion. And if I can see that, then private equity can see that at least as well.
Yeah, I think we are done, Saurabh. I'll just make a brief summary of whatever you've said so far for the benefit of the audience, and you can add just to look upon this as closing remarks. I think the first thing that you said is that there is definitely an opportunity now with the rupee going where it is. We are looking at an accelerated depreciation in the next decade, perhaps, and that's going to have a very big opportunity for export-driven manufacturing sector, which so far probably India has not seen. We've been more of services oriented. That's the first one. The second one is how to handle this would depend from company to company, but there is a way to handle this smartly and have a good amount of bargaining power with your clients abroad, acquiring, or aligning with the FTA opportunities that are going to be coming up in the next 1 year will also offer another opportunity. So I think those are the 2 or 3 couple of points that you mentioned. Anything that you want to add?
Yeah, the other piece was that the really clever guys, what I'm seeing, the really clever guys are doing is they're already moving to buy small assets, right? So say a friend of mine, he runs a auto ancillary company with, say, revenues of around $100 million, but he's now moving to buy for $5 million a small German brand, marketing team in Germany, which comes with the brand, and a warehouse. And this strategy of do the labor intensive, high processing work in India, then ship the stuff to Europe or America in disassembled format, do the final assembly over there, put a made in Europe, made in America, local brand, local health and safety regs, and get a premium pricing and be inside the tariff wall. And that seems to be the strategy I'm increasingly seeing the smartest small to mid-sized manufacturers are following. If you have the means to do that, nothing like it. If you don't have the means to do that, perhaps you make that an aspiration over the next 3 years or so.
Okay, thanks, Saurabh. Manoj, over to you for the questions, and then we can wrap.
Yeah, thanks, Anupam. Yeah, so there is a few questions, and I'm just going to sieve through them. Just give me a moment. So yeah, there is a question that Saurabh, I don't know if you will agree to do this, but can you put a number to where you think the rupee is going to be?
I have no idea. I have no idea. I've never
months from now or 12 months from now.
I don't care about it. As a businessman, woman, you have to have the guts to understand the world and take a view. But I honestly don't know. So what I've done, as I was saying, as a person running a small business, I've done for myself, and I'm encouraging all our clients to follow suit. Put half of our money, half of our investments are now in US dollars, and half are in rupees. Right, so we've historically never had half of our investments in US dollars, but we believe it's the right strategy to have. If the rupee falls quicker, we benefit some more. If the rupee falls slower, our benefits come a little later on and little further out. but I don't know of anybody. I don't know of anybody who can accurately forecast currency movements in the short run. What we can do is structurally understand shifts in the economy, which is what I've tried to do on this video call.
Okay. So that begs another question. De-dollarization, which is what you're seeing now, every country is trying to kind of, hedge themselves and reduce their dependency on the dollar, right? So as you said, 50% of your investments are in dollars. So in the in the event that the dollar itself depreciates, maybe not against the rupee, but against other major currencies, then what do you think will be the impact of that?
So this is where
And do you think that it is even possible?
This is where studying a little bit of economics helps. So when I was studying at the LSE, I was asking myself, what is the point of all of this? Why am I spending so much time in classrooms in London learning high flown economics? But at the ripe old age of 50, I'm glad I did. It helps to understand how the world works, and the world works a little bit different from what WhatsApp University tells you. So this is how the world works. Suppose, so let's take a Indian export. Let's take a tea company, right? Tea company selling tea to a hotel in Kenya, right? Now, the WhatsApp University will have you believe that the tea company in India and the Kenyan tea buyer, the hotel in Kenya, will have a discussion about de-dollarization, right? Unfortunately, that's not really practical, because the Kenyan doesn't have rupees to pay the tea exporter in India. He simply doesn't. The Kenyans, tourists are Europeans and Americans. They are paying him in dollars. The Kenyan simply can't access the rupee foreign exchange market, and he has no interest in doing so. And the Indian tea exporter is not going to accept payment in the Kenyan currency, right? I think shilling it's called, right? So the Indian's not going to take Kenyan currency. The Kenyan doesn't have rupees to pay us with. So naturally, the trade will have to be in a neutral currency, right? Everybody with me so far, right? I'm taking a typical global transaction, right? A straightforward, they're selling tea to a Kenyan hotel.
Yeah.
Right? They don't have rupees to pay us. We're not going to accept their Kenyan currency. We'll have to settle on a neutral currency. Now, which currency will we settle on? Will we take the Chinese currency? China doesn't have a convertible currency, right? China doesn't have a fully convertible currency. I doubt anybody in the right mind will do that trade in RMB. Will we settle for the euro? We might, but the fact that Europe doesn't have its own armed forces and needs NATO protection to survive a Russian onslaught will play on our minds. And as a result of that, the most likely currency is the dollar. It's the most likely currency today. It was the most likely currency 20 years ago or 10 years ago. The amount of global trade that gets done in dollars today is exactly the same as it was 10 years ago, right? And the reason for that is, as we are discussing, right, that if the global economy is billions of such small transactions, and nobody has the time to figure out on every bilateral deal whether I'll take your currency or my currency. Everybody does the trade in dollars. Now, if you do the trade in dollars, now replace the Kenyan hotel and the Indian tea exporter with Indian oil and Saudi Aramco, right? We need Saudi Aramco's oil to keep our economy going, right? That trade will be in dollars. Saudi Aramco ain't going to take rupees, and we don't have Saudi currency to pay them with. The trade will be in dollars. Now, here is a stunning bit of how the world works. Every dollar trade, every dollar payment in the world goes through the banking system in New York, every single one. So even if we pay Saudi Aramco $100, or the Indian hotel takes $100 payment from the Indian tea exporter takes $100 from the Kenyan hotel, that payment has to go through the banking system in New York. And here is the really tricky part. Any payment which goes through the banking system in New York, the Americans can stop that specific payment. So if, for example, the Americans stopped Saudi Aramco from getting paid by Indian Oil, right? Indian Oil will have a SBI bank account in New York. They will use that SBI bank account in New York to pay Saudi Aramco. If the Americans stop that trade, you can imagine what will happen to our oil supply, right? So this is how the global economy works. And typically the currency which dominates loses way when it loses a war. So till 1940, British sterling was the currency of choice for the global economy. In 1940, Hitler hammered the crap out of Britain, by bombing Britain and coming up to the shores of France. And that year, in 1940, the world shifted from GBP to USD. So if people on this call or anybody out there believes that such an event is imminent, where America will lose a war to Iran or China or Russia, then the fears of de-dollarization are warranted. But I'm not so sure that event horizon is anywhere near us today.
Got it. Okay. Okay, just I'll take two more questions and I'll request you for quick, short, crisp answers here, Saurabh, before we hand it over to my colleague Prateek for the vote of thanks. So, with these borrowing costs in USD remaining high globally, right? Should export-focused companies use current Forex tailwinds to fund their domestic capex organically rather than relying on ECBs, external commercial borrowings?
I think borrowing in dollars today for Indian exporters, I'm saying this is for Indian exporters, I think borrowing in dollars today is a very dicey proposition. Whatever optically the interest rate looks to be, in reality, the interest rate will turn out to be far higher for exactly the reasons we've discussed over the past hour. I think the rupee will slide, and hence your effective borrowing cost will end up being far higher than what it looks optically today. Given that in India, the interest rate rise cycle hasn't yet kicked in, if you're looking for term loans, if you're looking for capex, project finance, if you're looking for project finance in term loans, I appreciate it's hard to get in India, but if you can get a project finance in India, nothing like it. If you're getting project finance from abroad and it's in dollars, be very, very careful, because I think that will end up becoming a very expensive loan in the years ahead.
Okay. Last question. What do you think will be the impact, if at all there will be, right? What do you think will be the impact on the USD INR exchange rates from the US tariffs, impending tariffs?
So I mean, let's break it in two parts. I think the tariff regime has already been revised by Trump. I think that this recent 10% labor, punitive labor, while I think kicks in a couple of months. I don't think that will do us any favors. My reading is once that kicks in, the currency will have to depreciate a little bit more to get our exporters back to parity. But I think the big one to look forward to is at some stage we will be able to reach an FTA. I don't exactly know when that date is. Every time it looks like it's around the corner, some event kicks in. That FTA potentially allows us to be just like if I take the European FTA, if we're able to get a similar FTA with America, where for single-digit tariffs, remember our exports into Europe as per the EU FTA, everything we are sending into Europe will have minimal tariffs, 2-3% or even less than that. If we can get a deal like that done with America, right, low single-digit tariffs, if an FTA with America can be done with low single-digit tariffs, then I think at 100 to the dollar, at 100 rupees to the dollar, we'll end up becoming 10-15% cheaper than China, Vietnam, Bangladesh, and that will be the beginning of a sustained boom in our exports. The question is, does our government have the bargaining power to take our tariffs with America down to low single digits? And the answer of that, I think, lies in geopolitics and the dynamics between the leaders of the two countries.
Okay. Thanks, Saurabh. So before I hand it over to Prateek, a quick check with Anupam here. Anupam, any thoughts that came to your mind as Saurabh was answering these last few questions? Do you have any last-minute questions here? You're on mute, I think.
Anupam, you're on mute.
Yeah, sorry about that. I don't have anything much to add, Manoj, because I think Saurabh's left us on a very positive note. Like he said, the biggest takeaway for me was the fact that he said that the era of 91 to 2026 is pretty much over. And I think, when these days when we wake up, there's always some news or the other from the US. And I think that if India can survive this geopolitical chaos and come out of it winning, then I think the fruits are there for everybody to earn. But I'm not sure whether it will be available to everyone. It looks like it will require some pretty hard thinking and tough decisions that I think most of us are capable to take. So I think that's it from my side.
Yeah, hard decisions in that, some of these exporters may have to even shift their domains from, like I said, not as drastic as textiles to steel, maybe, but maybe from textiles to leather or something of that sort, right? Which is closely connected, but yet it's a shift in domain. And see, the large ones can do it, but the small ones will have a bit of a challenge thinking about it, even, right? Okay, with that, I'll hand it over to Prateek to formally deliver the vote of thanks. Yeah, over to you, Prateek.
Thank you very much, and good evening, ladies and gentlemen. I think as we come close to yet another insightful edition of IACC Thursday Night Insights, it is my privilege to propose the word of thanks. Thanks, Manoj, on that. So today's discussion actually reminded us of exchange rates and not only scoreboard. The real game is competitiveness, I guess. So I think Saurabh wonderfully explained, despite the global crisis, geopolitical uncertainties and changing economic cycles in the last 3.5 decades. Just Anupam just reminded that India has demonstrated resilience, I guess. So remarkable resilience. I think the recent RBI measures also has done where FCNR inflows have been increased. I think almost around $34 billion, just to ensure that resilience is there. But I think what we heard today, and while capital inflows and the resilience are all okay, but true strength, I think our economy lies in ability to consistently earn foreign exchange through global competitive exports, and that's the key. I think India IT and what is the next? I would say alternative to IT sector, or IT or technology sector. So those things remain. I think strengthening manufacturing exports across sectors like engineering goods, pharma, automobiles, chemicals, textile, and gems and jewelry, with MSMEs actually as a backbone for this transformation is really good. So we all aspire to be Viksit Bharat 2047. And our ambition is not managing just rupee and dollar, which Manoj was telling, but India must aim actually in all our listeners who are there. They should aim to ensure that manufacturing and services are really globally competitive exports. That's what it is. So on behalf of that's what it is. I just wanted to share that. On behalf of Indo-American Chamber of Commerce, extend a very heartfelt gratitude to distinguished speaker Saurabh Mukherjea. Thank you for sharing not only your deep understanding of market and macroeconomics, but also compelling vision of India's long-term economic journey. My sincere thanks to Anupam as well, Anupam Gupta, whose engaging style, insightful questions you asked and all, and effortlessly just hosting this. Today's conversation was enlightening enough. And of course, last but not the least, thanks to Manoj, friend, he's the Regional Vice President, Indo-American Chamber of Commerce, West India Council, for moderating today's session and with clarity and balance and asking all the relevant questions. So to all our members and not even members, please become a member. To all business leaders, entrepreneurs, and participants, thank you for enthusiastic participation. And I saw one message that, yes, a crisp session, and it was a very meaningful point-by-point session. So engagement is what makes our IACC Thursday Insights series such a meaningful platform for learning, dialogue, and collaboration. I would also, I think Parva is there, okay, it can be online, but I would also place and record sincere appreciation to Parva, the IACC Secretariat, Parva, Vishnu, for their meticulous planning and seamless coordination for today's program for a grand success. So that's what I just wanted to have one insight. If I can surely give you all a great, I would say that currency will fluctuate and capital will inflow in and out. But nations to become truly prosperous is that we innovate, we manufacture more, we export more, and create a greater value for that. So that's it. Thanks again on behalf of Indo-American Chamber of Commerce. I wish you all a very good, wonderful evening and weekend to come. We all look forward to you again, all the viewers or listeners, for next edition of Indo-American Chamber IACC Thursday Insights.
Thank you so much, Prateek. Thank you.
Thank you, everyone.
Thank you.
Bye. Have a great evening.